Hey everyone, welcome back to another episode of the Stage Debate Podcast with Classic Isaac. I'm your host, Isaac Weinberger. Today we bring on two fabulous guys, folks that have made tremendous headway and a tremendous impact in the hospitality space. Raman of PeachState Hospitality. What a guy. What PeachState has done over the years. Thank you, Ricky, for coming on. And then we also have Sagar Parikh of Spark GHC, based out of Ohio. Sagar is based out of Manhattan. And what a guy as well. A good friend of mine. We've done such nice work for them. And just such a great group of guys that have made tremendous headway in the space as well. And continue to make great strides. So very, very excited to hear what they have to say about so many interesting topics. Thank you so much to Prajesh Patel of Creative Lending Solutions, based out of Illinois, work nationwide. These guys are incredible. Loan originators, guys that can get your deal done, CMBS, SBA loans, and other type of loans. These guys are closing left and right. They bring something really special to the table. So thank you so much, Prajesh, for the episode sponsorship. I wish you nothing but the best. Appreciate you, man. And last but not least, thank you so much to our corporate sponsor. This cannot happen without you, Michael Stern of Line Star Tax and LST Consultants. Real tax geniuses. They bring so much other value to the table. Definitely folks that you should connect with and talk with. But tune in, guys, because this is going to be a good one. Hey, everyone. Welcome back to another episode of the Stage Debate Podcast. Today we have two fabulous guests, Raman from PeachState Hospitality. And PeachState has done tremendous things in the space. Atlanta-based, correct, Ricky? Atlanta-based?
That's correct.
Atlanta is one of my favorite places. So much going on there. And we have Sagar Parikh from Spark GHC, valued and dear clients. And you guys have done tremendous things in the space. I don't know if it was Bhavin or Bhavesh, your partners, but I told them a while ago, I said, if my little blessing means something, I said, I fully believe that we're talking about noble territory in years down the line. We're talking about noble stature. You guys are really making headway in the space, as well as PeachState. And it's just incredible to have such big guys on, some guys that have real advice to give other folks, so many guys starting out. And I had the opportunity to meet Al Patel from Baywood a few months ago. And he told me, he's like, Isaac, he said, if I was getting into real estate today, I wouldn't go into hotels. He said, it's a very hard industry today. Things are just not matching up. I'm deeply involved already, so obviously it makes sense. And so if you can go ahead at a certain point in this episode to give that advice to newbies, what you guys do and how you do it, that would be tremendous. So we'll start with Ricky. Ricky, tell us a little bit about yourself. Congrats on the new baby. It's a beautiful thing. Tell us a little bit about PeachState Hospitality, how you started, and what you guys are up to today.
Sure. First off, Isaac, appreciate you having us on. My name is Ricky Raman. I serve as the Chief Operating Officer of PeachState Hospitality. We are a independently owned owner-operator developer, not uncommon to many of the stories in the industry. And started the business about 35 years ago with a mom-and-pop 16-room motel my father did. Since then, we've focused our efforts in development over the last 30 years. We've turned over around 74 different assets from a construction standpoint, where we've provided our own GC services as well as development operation services. So that's been kind of our core focus. As we matured over the years, we had a management platform. We since then moved off from the management space, so we're clearly now just owner, developer, and asset manager. And over the last few years, we're really finding niche opportunities as well as specialist opportunities. You mentioned kind of the business and how tough it is to be in this business. We're finding more than ever, it's a business about specialties, picking the right market, picking the right spots, picking the right specialty to be in, and then being 100% in, right? You can't have one half foot in, one half foot out. So over the years, as I've come out of the business, it's really about honing in on what we do best, which is development and exit.
Got it. in your specific position in PeachState as chief operating officer, when you come to the office every
Right.
single day, what's your job?
So I sit on, multiple different hats, right? We're looking at my asset management business rolls up under my vertical operations. Obviously, we don't touch that much anymore, but where we do need to provide some assistance from a product quality standpoint, from a renovation standpoint, my team provides assistance in that. And I also sit on our development and capital investment committees, right? So any new deals that we're looking at from a ground up construction acquisition, or if it's reinvestment in capital, I sit on that team to where essentially all parts of the business kind of run through the operations hat.
Very, very cool. Very, very cool. And Sagar, all the way from Spark GHC. Obviously, a lot of your partners are based in Ohio. You're based over here in a beautiful state of New York, if we want to call it. Tell us a little bit about yourself, how you began, how you started in the space, and a little bit about Spark GHC.
Yeah, thanks, Isaac. Thanks for having me on. Really appreciate it. Sagar, Parikh, I say this is chapter 2 of my work life, Isaac. Right? Chapter 1, first born and raised in Cleveland, Ohio. And a Buckeye at that. But first chapter of my work life, though, Isaac, was public equities. So I spent 15 years on Wall Street covering public equities. So I was in a private bank at JP Morgan, did 4 years on the sell side at KeyBank Capital Markets, and then did 9 years at Cohen & Steers covering global infrastructure and midstream energy. Again, this is the second life, right? The second chapter in a way, and is very different, right? Coming into the private side. But essentially, the first chapter of my life allowed me to learn about strategy, allowed me to learn about financial modeling, allowed me to learn how to communicate with people, right? Sitting down and talking to high-level executives for the public equities that I covered. The second chapter really started due to the fact that Bhavin Patel has been on his podcast, Bhavin B. Patel. Bhavin and I grew up together. And for a long time, he used to talk to me about, figuring out a way to work together. And for a long time, I kept telling him, no, stop bugging me. I'm working in my dream job and I'm loving what I'm doing. But at a certain point, he was able to convince me. And so, Spark GHC, it's part of one component of Green Harvest Capital. Green Harvest Capital is assets for about $500 million assets, 1,500 multifamily units, and then about 2,400 hospitality keys. It's a 50-50 joint venture. Spark GHC is with Spark Capital Group. For me, again, I'm not an owner-operator. My partners, Bhavin Patel, Amit, Bhavesh, Mike, many of them have owner-operator skill sets. I've provided kind of the other overlay outside of that.
Investor relations and the like.
Exactly. Investor relations and the like.
Beautiful.
Branding, marketing, etc.
Beautiful. It's funny, if I just may add, that sometimes we do certain things in life and we don't see initially how that benefited us. For me personally, certain hustles that I've done in my life created a certain work ethic for me. But specifically in your situation, all the work that you've done on Wall Street and in the public sector probably really gave you an edge in terms of your fund structure to really have those connections that you can reach out to. If I may guess, I'm assuming that leverage that you have in the real world really helped a lot in many, many different areas. Is that a correct assumption?
Yeah, I would say, number one, I worked at large corporates that had great culture. So as I came into this business and helped start Spark GHC, one big thing I took from Cohen & Steers, KeyBank, and JP Morgan was corporate culture. How to treat your employees well, how to treat your team members well, so they want to be with you long term. This is an industry, multifamily and hospitality, where you have a lot of small business owners, right, that are developing into larger companies. By coming in from a larger company, I was able to bring, again, the mindset of, what's the right PTO policies? What's the right medical benefit policies? What's the right paternity leave, maternity leave policies, right? So again, number one, corporate culture. How do we build a company that people want to be with long term? Number two, the importance of marketing and branding. You're as good as your brand and vice versa, right? Those brands, those companies I mentioned that I work for all have strong brands. And so we put a big focus, a big emphasis on letting the market know who Spark GHC is, right? Why are we thought leaders? We want to be thought leaders out there. Why do we know what we're doing? What are our niches, etc. So I think number 2 for me is marketing and branding. Number 3, on a personal level, I spend a lot of days in Excel spreadsheets, right? So just from a numbers standpoint, again, having a good idea about, from a numbers perspective. Number 4, business cycles, right? So I was on Wall Street during 08, 09. I was there during the industrial recession of 14, 15. I was there during, COVID time period. And you learn how different businesses run through a business cycle, right? And so again, as I come into the private world, is having that mindset of, right, how does a business work through a business cycle? What are the ups and downs? What are we supposed to be looking for? And then number 4, having the capability and the ability to talk to anyone, right? Whether you're a team member that's working in operations, to a C-level executive, to an investor, to a partner like yourself, Isaac. I think what Wall Street taught me is you have to learn how to talk to people all in different parts of the circle, right? And the value chain in a way. And so Wall Street definitely gave me the confidence in doing that, which I really relayed into what I do here at Spark GHC.
Very interesting. Very, very interesting. Incredible. Wow. And Ricky, as you mentioned earlier, you're heavy on development. And obviously there's big upside in development. Everybody calls it create your own cap rate. It's hard. It's very, very hard. And we had some fabulous guests in the last episode, and we were talking a little bit about this, about the financing when it comes to development. Do you find that as a big hurdle, and what's your position? And we'll get to you, Sagar, soon. I'm curious to hear your take, because you guys are also developing as well. So stay tuned over here. What's your position in terms of the relationships that you have to upkeep and your full take on development as a whole? Because from what I hear in the marketplace, when you're buying an existing asset and it's already performing, obviously it's easier to get that financing. When you're developing a hotel, especially after COVID hit and banks are so much more skeptical about the hotel market as a whole, how do you handle that?
Sure. You look at the asset class kind of really honestly, right? When you look at hotels, you look at kind of downturns or economic cycles, one of the things that we kind of evaluate is when you talk about debt as a hurdle, it's more of a debt as a function of the deal, right? You have to look at it in relative terms. Essentially, when spreads are low or spreads are high, you're putting a higher focus on that project. You're putting a much more critical eye on that deal. There are developers out there, myself included, Sagar included, that are doing deals when times are tough, spreads are high, times are low, or spreads are low, they're still doing deals. So development on that front is always going to require the most honesty in terms of your deal appetite, right? Number one, first and foremost. Number 2, it's relationship with your lenders on your track record, on your site selection ability, your ability to deliver on budget, on time, and relying on those cycle-tested abilities to say, hey, look, we know we're in a cycle where development debt is tough, right? But look at the track record we've developed. Look at the markets that we're in. Look at all the checks, all the boxes that we need to check. The assumption is that the right sponsor is going to put that in front of the lender's desk to make that decision, right? And on top of that, it's a specialty business. Like I mentioned earlier, it's in terms of finding the right contractor, finding their ability to be bonded, giving the lender the assurances that they need to build in this market only further puts you up the list on getting a deal done, right? And the last thing I'll say on that front is when we look at development debt kind of in its totality, it's always got this, cloud over it that lenders don't want to lend to this particular asset class. Well, that's true in part, but lenders don't want to lend to certain people where there's risk inherently built in. What our job as a sponsor is to remove as much of that risk and be as transparent as possible and let the track record and let the deal speak for itself. That way, when they're at the investment committee, when they're looking at the pricing of their model, it makes much more sense for them to say, hey, you know what, Sagar or Isaac or Ricky, hey, you've done these types of deals. You're not putting your deal that's too far ahead of your skis. You're in the sandbox, and it makes a much more honest conversation for them. And the other thing I think too, you touched on earlier, brand selection, right? When we put the right brands or the right markets ahead of the development, we're not trying to build just for the sake of building. We're keeping a clean eye to where the market's at, where the market's heading, what the demand generators are. You put all those into a good calculation and you present that, and it's debt's always going to be there. It's a function of how much risk you want to take on top of it.
I like that. I like that. And I know for myself, when I invest in a deal, when somebody just throws out a crazy equity multiple, it's like, that's a red flag right there. So when you come to the banks as well, and you're not shooting for the stars, you're telling them and you're being transparent exactly what you're predicting. And in really case studies of previous hotels that you guys have done it with, they can make an actual decision. Do we feel comfortable or not? My question is, the follow-up question is that when you hit a new market, right? So you have new banks, new lenders, how does that work?
It's relying on the market intelligence that you have to build, right? Coming into a new market, you have to spend the time up front, right? What the assets are there, what assets are coming, how they have performed, what your underwriting is, what is your cushion or your hedge that you're going to build in. Essentially, the more information, the more feasibility studies you can do, the more underwriting you can do, the more intelligence you can put together. I think that's going to set you up for success. But also, you have to have a little caveat of, I'm coming into a market to learn as well, right? It's tough to go into a market thinking that you know everything. There's been many instances where we have undershot our projections because we thought we knew everything about the market, and to our benefit, the market produced or generated higher returns than we anticipated, right? And sometimes it's on the opposite, right? So learning what the cyclicality of that market is, where that market's heading, and finding on the ground support, right? One of the things that we found in any new market that we've gone in is talking to the local lenders, talking to the local developers on where they see the market going. That right there gives you so much good ground information to build your intelligence off of, to then go back and say, okay, if this market is where it's at right now, what do we see? How do we position ourselves? What the timing is? And ultimately, it's a great conversation and a great relationship with your lender, your brand partner, your investors on picking the time, because I'm sure Sagar can agree, picking the timing of a market is just as critical as site selection as well as brand as well. You want to time it the right way.
I mean, Ricky hit it on the nail when he said relationship, right? You got to create a relationship with your partners and your lenders, right? One big thing that we've said from the beginning of this business is we're not transactional, right? We're not in this business to be transactional, right? It's a small circle, but we're in this for the long term, right? And, as I mentioned before, business cycles, there's going to be ups and downs, right? And so you want to be able to work with your partners when it's good, but you want to work with them when it's bad, right? You want to have that open dialogue and transparency. And so we've always made it a focus on relationship lending, relationship partnering, right? So then in different points in time, people want to work with you, right? I think that's number one. Number two, there's a lot of doors, right? And one thing I realized with lending is that, there's a lot of doors that aren't open until one door opens, and then another door opens, and then you realize there's doors that you didn't know were there, right? And I think as you grow as a company, you grow as a business, you meet more people, and doors open that help certain projects work that might not at the beginning of your life cycle or in different parts of the business cycle, right? Products change, etc. As I think where I'm going there is a curiosity, right? Always asking questions, always asking lenders, what's new, what's there, what do I not know about, right? Because there always is something. And then three, I think it's not all about economics, right? Obviously, economics have to be there, but making sure that we let our partners know of, hey, we want to provide what we're working on is going to be providing a better product to the tenant, a better product to the guest, whatever that situation is. Number two, we want to be good stewards of the community where we're building or developing this asset. And then three, again, as I noted before, being a place where people want to work, right? All that stuff is important, right? Obviously, you have the quantitative economics of the model, which have to make sense, but where's the qualitative part, right? A lot of the lenders are, we have national lenders, we have regional lenders, but many times for development, it's local lenders, right? And you want them to know that, they're partnering with you and you actually do care about the community. You actually do care about the people where, they're located as well. And so I think it's a little bit of all the above.
Right. And I've seen posts from you guys on LinkedIn regarding like stuff that you guys have done for the community, giving back. And I think that's very important to be a part of the community. I think lenders like that as well, to see that you're actually invested in it. And just like really 1B on this conversation, because I never really had this twist. I'm curious to hear what you guys take. So I'm having a conversation with a hotel owner, big hotel owner, I think it was like a week or two ago. And we're talking about the intricacies of the difference between a True by Hilton and another brand of Hilton. And he told me a lot of hotel owners are frustrated because essentially you take a Hampton Inn and you take a Home 2 Suites, a Homewood, a True by Hilton. Obviously there's differences, of course, and that's why there's different brands. But sometimes the differences are very, very insignificant, and insignificant enough that when you pull off the highway on a certain exit, and in certain brands are more open to having different types of their own brand over there, it's kind of flooding the market because we thought we were going to be the only, I guess, limited service hotel, select service hotel, a Hampton Inn, but then you have a True by Hilton 2 miles away. It's like, do people really care as much as opposed from a Hampton Inn to a Fairfield in terms of loyalty and all that stuff? So my question is, I would love for you guys to talk about that, what your take is. But on top of that, are the banks, are the lenders having problems with that? Because technically, when you underwrite your deal and you plan on being at X at a certain point, and there could be another similar style hotel open up in 2 years down the road from you, that could really, really hamper your visitations, let's call it, whatever it's called, the amount of people that you bring in, the amount of guests you bring in. Ricky, can you shed some light on that?
Yeah, so I guess first thing, right? The bucket that all hotels are in are serving a clean, comfortable stay at an affordable price, right? Regardless of the brand, regardless of the location, that is goal number one, is to give your guest a clean, comfortable stay at an affordable price, right? How that's packaged up amongst brands is kind of where we are today, where we have different versions of different ways to package it up and create small nuances amongst the consumer. That's kind of the age-old business from a marketing standpoint, will always be there, right? Now you take that lens to a lender, 100% our lenders are asking what the current comp set is, right? 100% our lenders are asking what is coming into the market and will that impact your brand. Number three, they're also asking, is it in the same brand family, right? Will you be cannibalizing your distribution channels where you're fighting over the same 55, 60%, right? And number five is this the newest, sexiest brand that's out there? Are you putting your money, are you spending smart behind new brands that are leading the effort in terms of capturing in a new guest, right? Those questions are all valid and real, and those are all questions that we have to answer ourselves before we even take it to the bank. Now, I will say this, right? Depends on the level of the lender. If you go at the community bank, regional bank lender, I think they're much more critical in terms of who that brand is and what their sandbox is, because their sandboxes are pretty well defined, right? If you look at a mid-market, bigger bank, regional bank, larger balance sheet ability, they know the business well enough to know that in any market that's worth developing in today's age, there either is existing assets, signed assets, or assets under construction, right? So then they're looking at it from a lens on, well, what's the slice of business that you're going to go after, right? If the addressable market's 80%, they know that you're not going to capture 100% of that market, but they know that, are you positioned well enough to capture what your fair rate is, which what we call index, right? So they're looking at it from the standpoint of, what's the most efficient way for you to capture your fair share versus, are you going to be able to capture the entire market? Most lenders in our world and in the lenders that we work with know the business well enough to know that brands are important. Brands are getting further and further bifurcated in terms of consumer. But it goes back to the top of my question that if you're serving a clean, comfortable stay to the guest, brands matter in terms of bringing them into the door. But what matters is what your team is doing on site and the culture that's created on property to keep them there, right? The second guest, the second stay is much more important and much more sought after than the first stay. The first stay the brand's going to give it, the second stay we have to earn it, right? And I think that's where the lender's looking at the sponsor and the operator on, hey, do they have the system and the organization to take that first stay and turn it into stay number 2, 3?
Got it. But how's the lender supposed to know if in 5 years down the road, Hilton's going to come out with a new brand that is slightly different, but different enough that they could go ahead and put it 2 miles away from your residence inn, or whatever, residence is Marriott, your Hampton Inn. How are they supposed to know? There's no way to know that.
They don't know that. We don't know that. And that's some of the crystal ball risk that we take in development space, right? Since we started, I'm sure since Sagar started, there has been some double-digit number of new brands, right? Even back during my time at Marriott, we were saying, hey, we have 17 brands. That's going to be the max we're going to have. Now you look at with 30 plus, Hilton with 30 plus, IHG and Hyatt, so on and so forth. Those are part of the risks that we cannot accommodate for. But what are our controllables, right? A clean, comfortable stay, a product that's relevant, a team that's motivated, and a location that has market depth that, even if something were to come or a new brand were to come, we were confident that our product is still delivering a need or still supplying a need to the guests that are coming in. And again, newer, shinier is always going to be newer, shinier, right? But the culture that you build, it goes back to my point around, if I can take the guest from stay number 1 to stay number 3, clearly there's something that I'm providing that another brand's not, right? And that's the true battlefield on keeping business and not really so much worried about what the new brands are going to be.
Understood. I love that line in a very before, control the controllables. You know what I mean? We can't predict everything, but what we can control that. I like that. Sagar, what's your take? You guys are in multiple markets. You guys just bought something in Jersey. You bought something in Michigan. You're active in Ohio. You're active in New York. What's your take?
I'd say two things. One, the bank is trusting you, right, as the developer partner, that you know what you're doing based on your track record, right? So there's that relationship play again, right, with that lender and that bank that's looking at your track record and trusting that you have an ability to run your asset through different situations. I think 2, it's the relationship with the brands, right? You got to create a relationship with your brands, whether it's your Marriott, your Hilton, your IHG, your Hyatt, etc. So you know what's happening around your assets and in your marketplace, and you're not surprised, right? And so many times when we're looking at acquiring an asset and or developing an asset, we're talking to the different brands, right? And we're trying to figure out what has happened, what's happening now, and what could happen, so we can get around it or build it into our financial model, right? That's number 2. And number 3, I always use myself as a test case, and I say, when you talk about brands or flag and any of that, what would I feel comfortable with, right? What kind of brand would I feel comfortable staying in? I always use myself as a test case, right? Of like, what's going to have staying power and what's not, right? So, I think those are my 3 points.
I would also say too, Isaac, there's a lot of faith and trust that we spend behind understanding the motivations of our brand partners as well, right? They are obviously the ones with these new brands. Their goal is to develop them, and rightly so. It's understanding and trusting them that they're playing air traffic control with the most, balance-based system, right? What the most trust-based, what the most market demographic, all the economics, all the numbers behind deciding when to build or when to allow a franchise agreement. Most brands now have a tougher job, right? And one side, we're growing brands, right? But the job to manage who gets what and how those are developed and what the staging of that is and the scheduling of that is a tough job nonetheless. And there's a lot of trust that we put behind Marriott and Hilton and IHG and all the brand partners behind, they are going to select the right partner at the right time to build. That way there isn't a flood of 25 Trues or 15 Hamptons in a 10-mile radius or whatever that is, right?
And one other thing is market studies. And we do market studies, and they're not cheap. They take a lot of time. They're very important, right? Because they tell you, again, a lot of the data that you need to know, Isaac.
Very cool. Sagar, can you talk for a minute or two about Project Scarlet? Such a fabulous and cool project, and can you fill us in a little bit?
Yeah, so Project Scarlet, it's our redevelopment project in downtown Cleveland. It's actually the old Medical Mutual headquarters, right in the heart, right next to Progressive Field where the Guardians play, across the street from Quicken Loans Arena where the Cavaliers play. We say it's the entrance to downtown Cleveland. And Medical Mutual during COVID needed to downsize. As everyone knows, probably that's listening to this, office buildings in downtown Cleveland and really all around the U.S. Are seeing higher vacancy numbers, and we saw a really good opportunity to buy a building that had, again, a really good location, but importantly, a really good structure, exterior and internally. And so what we're doing is we're working and redeveloping it into Marriott branded Tribute Hotel, along with Marriott branded Tribute Apartments. It's actually based on who finishes first, it's going to be the first or second Marriott apartments to rent in the entire world. So we're very excited about it. We think it's the next phase of where developers like ourselves, along with the brands, are gonna go. Right? I always say, hospitality brands have gone like this, right? There used to be 10 brands, now there's 50, right, within their ecosystems. Well, at a certain point, you're going to tap yourself out from an ROI standpoint, and you're going to start hurting your EPS growth and your overall earnings per share numbers. Well, if Wall Street still wants you to grow, if you're a Marriott or a Hilton, etc., and you can't go this way, you're going to have to start going this way into other real assets, right? And so I think the strength of a Marriott's Bonvoy system, Hilton's reward system, IHG, Hyatt, etc., is going to allow them to start going horizontally now into other real assets. And so you're going to see them get into, utilizing their name power, their name brand into things like apartments to rent, right? Again, so we think, 10 years down the line, 5 years down the line, this is going to be right up front and center, and we're still in the beginning stages of it. But again, it's going to be a joint Tribute hotel along with branded apartments. And the other reason why it works for us is you get the construction efficiencies from a cost side, but then you also get the operating efficiencies, right? So utilizing hotel staff to help with the apartment side, and then vice versa, amenities that can be shared. Think about, for example, an apartment tenant was a 12-month lease, getting once a week cleaning services, right? So again, the ability to cross services.
Very cool. And follow-up question. I'm gonna get to Ricky. We'll get to you in a half a second. So yeah, I've seen all the stuff on LinkedIn, and I know the Curry Hospitality is involved. Paul was on the podcast, and if they're involved, it's going to be beautiful because they know to finish it up. But you together with them, that's beautiful. I know we don't have a lot of time, but even just for a minute, because you guys are a fund structure, what would you tell if I was a new investor today, picking your brain about Spark GHC? Obviously, we talked about transparency, we talked about relationships, and that's so important. And you guys do give that over, and it's so true. You guys are transparent, and I love the conversations that I have with your team members. But what would you tell the world out there? What makes you guys special outside of anything we already talked about?
Yes, I will say, so we are a retail investor model historically, Isaac. So we now have 518 unique investors and unique investing entities that have trusted us and supported us over the lifespan of these companies. We started with one investor, right? Every project that grew based on us delivering results, but also people trusting us. I think from our standpoint, it goes back to those mission points that I kind of alluded to earlier. Number one, we actually care about giving a better product to the guest or the tenant that is staying at our apartment complex or is that staying at our hospitality asset. Number two, we really want to be good stewards of the community. Right? We want to these are assets that are located in our backyards, but even not in our backyards, but areas that we actually do care about improving, again, the community. Number three, Again, a great place to work. We want to be a place where our team members want to work for not 1 year, but 10, 15, 20, 25 years. We're not doing this for a 5-year gig and we're out. We're doing this for the long term of creating a real business. And then number 4, fair and balanced return to ourselves and our investors. No one's in this to hit a grand slam. We're going for a double every single time or a triple every single time, but one that's fair to us as a sponsor and you as a limited partner.
Beautiful.
And you're having fun while we're doing it.
Yeah, I like that part. I think that's
Every day is a fun day, right? There's going to be moments, right? Every business and every job has moments, but myself and my partners, we're having a ton of fun doing this every day.
I love that. I think that's so important. Very, very cool. And Ricky, tell us, obviously, from you guys don't have a fund structure, but if I was a lender, if I was a broker, whether it's brokering land deals or you're buying an existing asset, what if you would have to, I guess, tone it down into a few sentences? What makes PeachState and yourself and your team special? Because we heard about the transparency, we heard about the knowledge that you have in the space, which is tremendously vast. But what separates you from the pack?
Well, it kind of boils down to a four-legged stool of our business, right? Associates, guests, stakeholders, and communities, right? Sagar touched on a little bit in the community piece, but without any one of those, what we do does not enable us to shine, right? We have to care about our guests. We have to care about our associates, our stakeholders, our investors, our brand partners, our lenders, as well as our communities, right? So when we go into a new deal or represent PeachState, we like to show and prove that we have cared and continue to and will care about every part of the success stool that we have at PeachState, because without any one of those, the business kind of falls flat, right? And I think that's core to what PeachState does. It's core to a lot of hoteliers in this space, that developing operational expertise around those 4 core tenets will take you far. And again, it allows you to rely on a track record that you can hone and get better as you go. To, and Sagar's point, having fun along the way, right? We are in a business where we've seen so many different cycles and cyclicalities of hotels being the hottest investment vehicle versus hotels being the not hottest hotels investment vehicle. Obviously, we are married to the business, but with that, you learn a level of transparency and honesty with the relationship you have with the business. I think that no matter how long you're in the industry, you will continue to learn more and more as you kind of dive deeper and deeper.
Beautiful. And with that, we're gonna kind of end the show, but I just want one more thing from you guys, and we talked about it so much. If you had to give, I guess, one piece of advice that guys starting out in the hotel space, we talked about, again, all the good stuff, have fun, transparency, real relationships. How would you nail it down into one sentence to a brand new real estate hotel investor?
I think what for me, I would say curiosity, right? Curiosity of the why. I think that is going to lead new leaders into the right area. Why not? Why so? Why this? Why that? I think having a sense of deep inherent curiosity will position you to ask the questions of your lender, of your brand partner, of your investor. I think that curiosity is something that all developers and owners in this space, certainly real estate, have to have. But I think taking that and putting that as your kind of guiding principle of being, ruthlessly curious, I think is something that's certainly helped me. I would recommend that to really anybody.
Beautiful. And Sagar, piece of advice we give to a brand new guy.
Yeah, I think have a long-term mindset, right? Don't think about this being a near-term or short-term win, right? Think about the long-term, right? And with that, the relationships, right? If you're a transactional person or a transactional company, at some point you're going to get cut out, right? And or when you need the help, it's not going to be there. So again, relationship is, I think, one of the big keys of our business that we're always focused on every day, right? And that doesn't mean it has to be one partner, right? You can have 1 or 2 or 3 partners for the same variable or vertical, but it's, hey, be open, be transparent, create those relationships, and think long term.
Unbelievable. Thank you guys so much. What an episode. Very, very exciting. An exciting talk with Sagar and Ricky. Excited for our listeners. stream on all platforms. If you'd like to be a guest on the podcast, if you'd like to talk cost segregation and unique twist and value that we bring to the table, reach out to me and my team, and see you on the next one.